Good morning, traders, and happy Friday. It is 8:01 a.m. Chicago time on the 24th of March, 2023. One more Friday of this month, next Friday, before we wrap up this month. This is episode number 2436. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. Quick mic check, please, as we dive into the convergent trading pre-market summary sheet. I'm sounding like a broken record. Every day is basically the same these days. However, we do see some real signs of the banking sector, same as 2008. The banking sector kind of having a hard time. That's the big news today. We have Deutsche Bank's CDS values really spiking. Germany's largest bank has seen $3 billion wiped off its market value in the space of just 1 week. Deutsche Bank. Deutsche Bank's credit default swap CDSs, its insurance for bondholders, shot up 220 basis points. 220 basis points. That's a lot. The most since late 2018, from 142 basis points just 2 days ago, based on data from S&P Market Intelligence. This was from Reuters. And what this is saying, it's kind of a cycle with these banks, right? It's kind of a run on the bank, same as what we would have when you have a run on the bank. A run on the bank is people go in and demand their deposits be returned, and as a result, the bank has fewer deposits. The more the bank has fewer deposits, the more people panic, and then they demand their deposits back, which is basically what happened to SVB. And the bank then gets to a crunch because that money just doesn't sit in a safe somewhere ready to be liquidated. CDSs are kind of the same, where the bank's credit rating in terms of insurance drops. People start to have a panic. Businesses start to have a panic. The market in general has a panic, and the value of the stock falls. Therefore, the CDSs go up, and which makes the stock look terrible. So the stock falls, CDS goes up, and so on and so forth. And that's, in a nutshell, in layman terms, that's what's going on. Yellen's comments yesterday on the U.S. being prepared to take more actions to ensure deposits are safe. She's walked back some of the comments she made after the Fed decision on Wednesday, but overall, she has very little power to do anything with these banks. So that's where it stands. Fed's Bostic asked about case for leaving rates unchanged. Some were willing to say uncertainty is really big, and we should wait. And then this morning, the news feed is full of people coming out and saying there's no problem from the European side, coming in and saying there's no problem with the banking sector. It's very unlikely we'd have another Credit Suisse situation. It's very unlikely that the banking sector will fail, which I've been doing this for 23 years, and I've been through these crises several times, and I'm going to tell you that generally foreruns or pre-tells that the banking sector is in pretty bad shape for them to come out and say it's not going to be that bad. Well, if it's not, then you wouldn't be commenting on it. So that means it is. So that's where that sits. There are a lot of indications that we are really not seeing the decay that's going on under the covers in the financial sectors, it seems. So we may see increased volatility going forward, which I would love. Possible announcement by FDIC over the weekend on the sale of SVB Accenture plans to lay off 19,000 jobs over the next 18 months. And remember, it is unemployment, the unemployment rate, and the jobs numbers that are giving the Fed this cushion and this confidence that everything is going to be A-OK, that there isn't a recession. And we've seen this a while ago, September 2007, going into 2008. We saw the same kind of scenario where everybody's touting the unemployment rate. In the meantime, Lehman Brothers was holding garbage in subprime mortgages, and the banking sector is really struggling. So you're seeing these layoffs with Accenture. We saw Facebook, I think, laying off an additional 10,000, or Amazon, was it, laying off an additional 10,000. At some point, it's going to hit critical mass, and we'll see the results here. Anyway, I'm not a macro analyst, but there's a lot there, and it's damn interesting, and that's why I'm sharing it with you. Today, we have mild risk off. The European markets, as you see, getting hit. That's on the Deutsche Bank news, and potential contagion in Europe, and Lloyd's Bank. And we did get some numbers today. We got durable goods, which missed quite a bit. It came in at negative 1% versus 0.6% plus. So the durable goods orders were expected to increase by 0.6%, but actually they decreased by 1%, which is quite a reversal. We have in front of us Fed's Bullard at 9:30, right at the open, and then we get the PMI flashes. Next week, just as a quick look, next week, the key remaining number next week is the PCE number, which is really important for the Fed. However, PCE is for February, and it is delayed too far into the month, so there's more emphasis on CPI, which is one of the first inflation numbers in the month. But there's testimony on the Hill for bankers, so we'll start to see what's going on under the covers there in the banking sector and so on. Next week has several items that may help move us around. Looking at the S&P now, multi-distribution profile. The S&P is in active price discovery, selling to the downside. S&P is down about 26 points. We are currently just on the edge of yesterday's range. We've gone back down to the lows of yesterday. 350,000 contracts have traded, which is higher than what we would consider to be the edge of normal. So this is 2 standard deviations into the 2 standard deviation zone. It's above 1 standard deviation over the last 252 days to have 350,000 contracts traded. The inventory is 43% short, not too short, not balanced, and the range is 61.25 points. So this is telling us that the market is really busy this morning. Notice the point of control is hovering around that 39.4775. 39.4775 is last week's point of control for the week. So we are, excuse me, I'm losing my voice. So we are really. We have basically tested up, been rejected at higher prices in the 70s, tested again yesterday in the 40, failed there, and have come all the way back down into the lower bounds. We're below the key 39.70. That's where the S&P is. Looks pretty bearish. Same with crude. So let's look at the charts. Here we go. So looking at the charts, again, this is your Fed day here. And then what we did is we opened in the excess low yesterday as discussed. And the expectation is that it would push up, but it wouldn't push up very far. This ended up going right back to the prior point of control, which was expected for the NASDAQ because the NASDAQ is a lot more bullish or a lot stronger than the S&P is right now. But for the S&P, I expected quite a bit of resistance on the way up around 40.20, which actually provided some pretty decent setups yesterday, 40-20, and then it started to fail from there, and it pushed all the way down below where we closed on Friday. So yesterday I expected, the primary expectation was for it to chop in that range between the low of the prior session, the FOMC session, all the way up to about 4,004 or so. That's where I expected it to go. I was completely wrong. It had a lot more strength, surprisingly, a lot more strength in the morning, and it had a lot more weakness in the afternoon. So it is just, it ended up putting in a weakish low and then closing or settling at 39.78 above the key 39.70. So to me, it looked like a poke below the Fed, but it finished positive against the prior settlement. And then here we have the news, and we find ourselves on the extreme. So bulls are really supporting this. They're really looking at these prices as bargains. But the news keeps playing whack-a-mole with these bulls and beating them down every time the market climbs. So that's the S&P. The S&P has gone from moving into this upper box up here to now moving back down to this lower box. The point of control, this lower box is 39, I don't know, John, what is it? I don't remember where it is. It's somewhere in here, I think, 39.20-ish or so. So that's where we stand. Well, let me look for it because it's in the levels. So 38.97. Yeah, I'm not really sure. So that's where that stands. The S&P is looking pretty unhealthy. It looks like balance down at the lower end of the range. That's what it looks like. Let's look at this on the intraday. Here's what you've got. Yesterday, opens very strong, pretty decently strong, push higher, and what's going on here? Pretty decently strong push higher into the 40-40 area, almost to the 40-40. It went to 37, and then it sold off, and it kind of went sideways from there. And now we're squeezing lower. Let me move to this other chart. Here it is. So we have an open that flashes up, pulls back to the open, and then we're basically skating on the RTH VWAP. We're well ahead of the full session VWAP, full session mid, very bullish. And then it looks like a blow off top. And I mentioned this in the Convergent Trading Mavens channel. I said, man, that push looks like a blow off top. And then it managed to pull back to the IB. Very nice setup here. And then the IB setup really didn't get much more than 6 or 7 points before it fell back through. And now we're looking at it pulling back, and then it spills lower. I didn't find it easy to trade that sell-off. I found the this pullback to be very orderly right here. For the short, we had our group mentoring session yesterday, Convergent. We talked about this with one of the candidates. By the way, if you're a Convergent member, be sure to listen to that recording before it's taken down. It's really good stuff. A lot of stuff was shared yesterday by members as far as doing the work. And then you have these big swings in the afternoon and into the close. Just very, very much a disorderly auction yesterday. So we end up kind of flashing above and below and above and below the 39.70. We end up finishing above the 39.70, and then this morning on the return higher it fails, and then it falls through, and so now we're in the lower distribution. What are we looking for today in terms of what the market is likely to do? Hang on, what is going on with this chart here? This shouldn't be showing this stuff because we're saying no extended data, but it's showing it. Interesting. What are we looking at for today? The time framing is definitely to the short side, to the sell side. We may see an additional flash higher like we've seen over the last couple of days. We may see this thing push strong to the upside on recovery. I'll be watching the 3970 is the early line in the sand here. So 3970 right here is very important. Okay, so it's the mid of the session. We do have the point of control at the low end of the session. We have a nice little consolidation here. Any push to 3970 is a potential sell for me, and then a rotation down, and then I'm looking for the overnight stat to be taken out at the low. The overnight stat will be taken out at 3937, likely to run to 3920, and then ultimately we're looking for 3897-ish for balance, right? Okay, yeah, John confirms that. He's our ES Maven. 3987 down below as we take out the low if we do have a run today. This is the primary scenario that plays along with the downwards trend. This is the scenario that's expected. If it does squeeze higher, it is likely to encounter some resistance in the 3978 settle. It becomes a gap to settle trade in the morning. So let me change the color here for a minute to the secondary scenario. The secondary scenario would be open, consolidate, then we have an impulse higher, which case you would sit back. If it impulses into 39.7, we're not going to stand in its way and short it. Pushes into 39.7, continues. You have a gap to settle, trade into settlement at 39.78, likely to confront difficulties in the 39.80 area, and then pull back, consolidate until the afternoon, at which point I believe it would be tough to argue that you should hold these positions going into the weekend, given the FDIC is about to make a move for the weekend with SVB, and there's probably some more cancerous developments in the financial markets. So I'm leaning short currently. Where does that lean change? That lean changes if we push way up here, back over the 4,004. The 4,004 changes my view on pushing the short side or leaning on the short side for structured trades. If it pushes above the 4,004, it's going to be a short squeeze. It's very likely that many will get pushed out as part of a short squeeze once that happens. And then we're back at yesterday's high, 40.40 again, which is from the FOMC, 40.40 to squeeze, and then now you're looking for it to get back up into the 40.80, 40.90, and it becomes bullish again. That's how that looks. Let's take a look at crude for a minute. Crude, I mean, this thing has been recovering very nicely until this morning. Yesterday, it opened higher. It opened higher, and it really found rejection. So yesterday looked pretty good until it took out the prior session's low down here. Once it took out the prior session's low and finished at the lows in crude, the ball game kind of changed for crude. It attempted to push back up to this high volume node. Remember 70, I believe the number 70.80 was the key number, and we had our over underline up here at 71.50, something like that. And it tested that yesterday and failed to hold. So it finished filling in the gap from last week and then fell right off. And then this morning, this attempt higher really couldn't do much damage to what was done yesterday on the sell-off. And so we get this continuation lower. So crude is likely to attempt to push back up to the 69, here, not likely to get into the 70 before it starts to consolidate again and move towards the MC point of control of the lower distribution, which is at 66.80. 66.80 is the target for crude. Okay, 66.80. It's currently at 68.10. I'll leave you with that. Good luck today, and I'll catch you on Monday morning. Take care.